The way I tend to think about our approach to data and statistics is to think about them somewhat artificially as evolving in three phases. The reality is obviously more complex than that, and they bleed into one another. But broadly speaking, up until the scientific revolution, up until Fermat and Pascal came up with probability theory as we know it, and Bernoulli formulated the law of large numbers, all in the 17th century. Up until that point, insurance companies existed, but they really priced based on commercial negotiations. They didn't have the tools to assess risk. They used intuition, but basically they treated all of humanity as a monolith. I have a picture here of Henry VIII. He sold annuities and he would charge the same amount for the annuity whether you were 7 or 70 years old, quite oblivious to the radically different risk profiles in life annuities under those circumstances. And I represent this as a single block, and I'm going to spend no time on that. With the scientific revolution, the modern insurance companies were born. Many insurance companies today still date back to the late 1600s. And that's when suddenly this new technology evolved that allowed us to chunk humanity into groups and to use data and probability to do that in a scientific way. And while some things have changed, broadly speaking, we are still using the same methodologies today, and that's what I'm calling phase 2. Phase 3 doesn't exist, but it would be a phase in which we really drive the adoption of the digital revolution to allow us to use millions of data and to have those crunched by machine learning rather than by humans. We are at the cusp of that, but I will be talking about what may be possible, not necessarily this year, but in the years to come, and talk about that as the new trajectory. So I'm going to contrast phase 2 where we are and phase 3 where I think we should be going. So let me talk about phase 2. In phase 2, we chunk humanity into groups, best, good, bad, worst, what have you. And we use data and statistics in order to do that. And what we look for is expected loss. And this is the consensus among insurance regulation. In fact, it's required by law. So I will charge like risks, like amounts. And that's what we define today as fair. Fair is charging somebody the same per unit of loss, but not per unit of coverage. This is important, and I'll come back to it towards the end as well. Let's just think through the implications of that. So two people buy the identical piece of property, in this case a car, but it could be homeowners insurance, it doesn't matter. And here I've got Jack and Jill. They bought the exact same car on the same day from the same dealer. And we are quite okay with the notion that the insurance rates for identical coverage may differ and may differ significantly. In my case, Jill is charged $900 and something and Jack over $1,300. Now, why is that? Why are we okay with the notion that we're going to charge two people different rates for the same coverage of the same property? How do we determine how to discriminate between these people? Well, there could be any number of factors, but in answering the question of why are they being charged different rates, one answer may well be Y in the sense of the Y chromosome. Jack is a man, Jill is a woman, and the statistics on this are pretty stark. So here's an article from less than a year ago in the New York Times talking about the propensity of men and women to have crashes. So it turns out that male drivers have twice the rate of fatal accidents per mile driven than women do. And when you move into trucks, it's a 4x increase. And when you move into motorcycles, it's a 12x increase. So it would not be shocking if we knew nothing else about Jack and Jill other than the fact that Jack is a man and Jill is a woman. Based on these kind of data, it would make a lot of sense to distinguish between how much we charge Jill. Jill is a woman, women drive more carefully. Jack is a man, men have more crashes. So certainly we see a system developing, and indeed most states, including Oregon to the best of my knowledge, allow gender as a pricing factor. It is statistically sound. This is driven by data, by the numbers. But is it fair? Is this a desirable outcome? Is this the terminus, the destination that we want to get to? And I don't think it is. So I've drawn here, these are hypothetical graphs, the data is made up, but risk curves of, bell curves of what kind of risk women pose on the roads and what kind of risk men pose on the roads. The average risk in my model here on the risk between 0 and 100 is 50. And the average man has a risk factor of 60. The average woman has a risk factor of 40. Which is why, indeed, if we know nothing other than the gender of the customer, we should be charging Jill less than we are charging Jack. But note that we're really tarring all men with the same brush, because the worst of the women drivers are riskier than the average men, and the best of the male drivers are less risky than the average woman. So we are treating people who may be actually excellent drivers among the male cohort the same as the average man. We are applying to them the gender average. But as I say, if Jack actually is here on the continuum, he's being hurt by this. And if Jill is on this part of the continuum, really the prices should be reversed. But we don't know that. All we know is that Jack is a woman, a man, Jill is a woman, and we charge them based on that pricing factor. Now, it's important to note on this graph as well, and this is true of gender differences, of racial differences, and a bunch of other differences, that there are differences between groups. The kind of risk that women pose on the road and that men pose on the road are indeed distinct, but that the differences between members of the cohort is greater still. So the differences within a group are actually greater than the differences between groups. A fundamental and important notion for the direction that we want to take this whole industry. Now, you may say, okay, well, we don't like that at all. Maybe Jack is being discriminated against for his gender. Maybe we won't allow gender-based pricing, and you could replace this with any other protected class. And I'd have to ask two questions. One, is that fair? Is that actually a desirable outcome? Because at the end of the day, women are more careful drivers, and should we not find a way of passing on those savings? And secondly, is it actually possible to entirely separate out from our data sets not only gender, but things that proxy gender? And just to be playful, okay, we're not going to allow gender, but can I use shoe size as a pricing factor? Because I will be able to show with tremendous statistical significance that people with larger shoe sizes are greater risks on the road. And if you say, I don't want to do shoe sizes, how about reading materials? And you could go on and on. Do they drink Coke Zero or Coke Classic or any number, height, voice pitch, so many other factors that will proxy male or female customers and indeed will be predictive of car crashes. An interesting one, and may seem less absurd, is how about a history of car injuries? Well, that sounds like a good pricing factor before you find out that women are actually 47% more likely to suffer severe car injuries. And that is because cars were designed with male dummies rather than the female one that you see here. So here we see an interesting concept. If the previous concept that the magazines was a proxy for gender, what we're seeing here is an inherited bias. So you'd start seeing women indeed suffer more injuries, but they suffer those not because they're less careful drivers, but because the cars were designed for a larger frame. So the broader point I want to make here is that the phase that we're broadly in today has a structural problem. This is not incidental. This is built into the very way in which we think about pricing and bucketing risks. We use a few data, enough data, so that a regulator can review them in a lookup table. And those data, because they are relatively sparse, will almost inevitably lead to relatively crude groupings. And relatively crude or big groupings create two big problems. The first is intra-group, within the group. So if you've got a group, for argument's sake, that proxies gender, or as regulation actually allows gender, is gender, we see that we're treating Bob and Jack the same just because of their gender. But as we saw before, Jack might actually be a very careful driver. And the second, you're imposing a uniform rate on a non-uniform group. That is literally the textbook definition of unfair discrimination. And we allow it by law only to the extent that it's impractical to do any better. But what was impractical once upon a time is not impractical today. So I think we have to take another look at this intro group, that very idea that we are tarring, in my example, all men with the same brush, that we are taking the average man and applying it to all men to the benefit of some and to the detriment of others. So that's the intra group. And then of course, there's the inter group. So now we're pitting, in my example, men against women, but as I say, this would apply broadly to other classes that we want to protect and care about. And when we do this, we may find that even in things that we don't intend, gender, we actually ask the question, but even in other places, we'll find that there are proxies for protected classes. And this might be penalizing people in ways that we didn't intend for their gender or for their race. And again, this is not incidental. I think this is almost inevitable when you're just using a few data points. And this is similar to when we meet somebody and we only get an external impression of them. We use those first impressions often in a detrimental way to form a first impression, whereas, and oftentimes it will be based on externalities, the color of their skin, their age, the facial elements, the gender. And only once we push past those and we actually get to meet the person beyond and we get many, many more data, are we able to overcome those and form a much deeper understanding of the human being that stands in front of me. So what we really need to do, and this is where we start moving from phase 2 to phase 3, is break up these groups. We don't want big monolithic groups that have a high risk of both proxy discrimination and of being unfair to people because they're placed in it without being uniform people. And that brings us to what is beginning to be possible and what I think ultimately is desirable. So phase 3 is about crushing, using the power of machine learning and data to crush apart each of those groups, to break them up into their component parts, and to keep doing that, to relentlessly use machine learning in order to divide and split these coarse groupings. And the fantasy, and we're far away from it, but the terminus, to answer my question, is to get to a group of one, to stop looking at humans as being groupish and members of a gender group or a race group or any other groupings that we choose to put them in. And I think the fantasy, the dream has to be able to look at an individual as an individual and not as any of those external or superficial things with which we group them today. And here we do get a little bit philosophical, and I think it's worth spending time on what is the terminus, what is the desired point that we want to get to. And I, for one, would subscribe wholeheartedly to the Martin Luther King dream of not judging people by the color of their skin, but by the content of their character. And being able to go pierce through all of those superficialities and get as close as we can to understanding the human being standing before us and the risk that they pose. And if we're able to do that, if we're able to treat each person as an individual, that would leave no room for adverse selection. It would neutralize proxy discrimination, let alone overt discrimination. And it would be the ultimate fulfillment of the legal mandate that pricing should reflect with reasonable accuracy the differences in expected loss. So that is really the destination, I think. So a couple of points in getting there. The one is just to reinforce the notion that group size matters, and that the smaller the group, the less chance there is that we'll be discriminating in a way that is unfair. So rather than thinking about women as a risk factor or as a pricing factor, how about we break that up into 10,000 more dimensions so that the womanhood is entirely superficial and unnecessary, because we're getting down to how well does Jill actually drive, rather than looking at her gender or other elements of our identity, and same for any other protected class that we might be looking at. So splitting groups, getting to the individual, the smaller the group, the less discrimination, certainly unfair discrimination will be, and will be much closer to judging people by the content of their character. A broader point to make about this is that if we actually do that, if we use big data to break up these groupings, we will end what I call the tyranny of averages. So before we're treating all men as average men, all women as average women. I'm simplifying, but you understand the broad point, hopefully, that I'm trying to make. Whereas in phase 3, as I'm defining it, averages become unimportant. They are a facet of the world, but they're not a facet of our pricing. So if we do break apart these groups and get down to the individual, men on average will still pay more because men, in fact, crash more often. But equally, safe drivers will pay the same per unit of risk, regardless of their gender. And in phase 3, these two apparently competing statements can coexist. Let me talk you through that. So now we don't just look at gender, we're piercing through those groupings and looking at the individual. And we're pricing each person based on their risk. And in phase 3, we get to understand that Jack is actually a pretty good driver and we charge him accordingly, and that Jill is actually a pretty bad driver and we charge her accordingly, reversing today's pricing. And we do that for every human being along this entire continuum. Now, the problem that we saw in phase 2, where good men are charged as average men, disappears because in phase 3, all men or people are treated as humans. But note that the average will still be higher for men than for women, because the series, when you aggregate it, the series will still add up to 40. The average score for women will be 40, and the average score for men in my example will be 60, but nobody will have that applied to them. In phase 2, the average is applied to everybody, and in phase 3, it's applied to nobody. Averages stop having any hold over us. And that's why in phase 3, averages become an output, not an input, and that is why disparate pricing becomes uninteresting. I'm pricing people individually, and the fact that women on average are charged less than men is irrelevant, because I'm not charging people based on that average. I'm charging it based on who they are as a human, the content of their character. So disparate pricing becomes noise. It's no longer a signal. Well, then how do we decide if we've got a problem? We can't just hand this over to the black box and say, hey, you do your thing, crunch numbers and charge as you will. We have to have a way as an industry, as regulators, as companies, to ensure that the algorithms are fulfilling the potential as I'm outlining it, and they're doing what we want them to do. So how do we audit them if we can't have simple lookup tables and filed rates and forms, but there's an algorithm that we don't really understand that's using millions, sometimes billions of pricing factors in real time and crunching them in ways that are superhuman? Well, you can look at disparate loss ratios. I think this is a fundamental breakthrough for how we think about the next phase of the evolution of our industry, but it's really simplicity itself. Today we look, as I say, we audit rates and forms, which is a really tough way to ensure fairness. But fundamentally, what we're looking for is not uniform pricing, it's uniform pricing per unit of risk, which would mean uniform pricing per unit of claims. Now, that has a name, it's called a loss ratio. And what we really should be looking for is uniform loss ratios across groups. So this is what it would look like. An insurance company would have to report with whatever frequency regulators wanted, and based on any classes that regulators wanted, what do the loss ratios look, not just at the aggregate group, but by gender or by race or by any other protected class. And what regulators will be looking for is, are there classes that have statistically significantly lower loss ratios than others? And if they are, they're being overcharged because per unit of risk, they're paying more. And I know this simply by looking at their loss ratio. I don't need to look at whether the pricing was fair. Maybe men should on average be charged more, but that would reflect itself in the fact that claims to men would also be more, and the one would balance the other out, and the loss ratio would be consistent with women's loss ratio, even though women are being charged less. That puts insurers in an unenviable position of being able to use such a simple algorithm, potentially in real time and without having to do much hard work, in order to check that the system is really producing results that we feel proud of. And the amazing thing is it catches pretty much all forms of discrimination that we don't want. Whether the problem is that we're charging people too much or we're paying them too little, whether it's in pricing or in claims, the ULR, the uniform loss ratio, will discover it, whether it's an inherited bias or an inherent bias, whether the discrimination is explicit or by proxy, doesn't matter. This won't lie. If I'm charging people more per unit of loss, the uniform loss ratio test will reveal it. And so I want to end where I started, talking about the destination and the optimism that I feel coming into the next eon of insurance, if you like. Plenty of details remain. There are various ethical and other considerations that maybe during the discussion I can layer on top of this. But I do think it will be a real boon for fairness if we use algorithms and systems like the ULR test to keep algorithms honest. We'll be able to upgrade the fairness of our industry dramatically. So back to my opening 3 phases, humanity as one big monolithic group. Then in the last few hundred years, we are using statistics, probability theory, and basic data to create relatively crude groups. And in the future, and this is the terminus that I'm arguing for, we get to the point where individuals get rated based on their content of their character. What kind of risk they, not a group of broadly or superficially similar people, but they represent. Now, getting there moves us from requiring no data, Henry VIII, to requiring few data today, and historically the last few hundred years, to needing really very big data going forward. And that in turn means that we have to move from a system that requires no real intelligence to one that may do with human intelligence, to one that absolutely needs to adopt artificial intelligence, or else there's no way to crunch that big data. But I think it's worth it, because if we do this right, where we end up is we move from a system that was frankly dumb through no choice of the people, but they just didn't have the basic inkling of probability theory, to a system that is in existence today that I regard as maybe the best thing that we had up until now, but as dangerous. And we saw this with a woman-man example that I gave earlier, and we could apply any other protected class that we want. And ultimately, hopefully, drive us to a place that is desirable, where, again, harking back to Martin Luther King, we judge people not by the color of their skin, but by the content of their character.